Fundamentals of credit analysis. Section 6, credit risk versus return. The basic idea here is quite straightforward. If an investor is taking credit risk, then he obviously expects a high return for the risk that he is taking. And this is shown very well in this exhibit from the curriculum, where we look at returns for bonds with different ratings. So if you look at a AAA rated bond, here the average return is 6.18%. So that's the average return. The maximum return 16%, minimum return minus 4%, and average volatility about 4%. If you go to the other end of the spectrum over here and look at CAA bonds, notice the volatility or variation is much more. So the average return is about 8%. The maximum return 97%, minimum return minus 44%, and average volatility 12.6%. So the point is that as we take on more credit risk, the expected return is also up. Now this is the expected return. Obviously the actual return will vary, but again the main point is more the risk, more the expected return. On this slide, we'll talk a little bit more about yields and spreads. The yields on extremely liquid bonds with virtually no default risk will be equal to the real interest rate plus a premium for expected inflation. So an example here would be very liquid government bonds. Their yields will be equal to the real interest rate plus a premium for expected inflation. The yields on corporate bonds will include an additional risk premium that compensates investors for credit and liquidity risk and possibly the tax impact of holding a specific bond. This additional risk premium is called a spread. So if we have a risky corporate bond, there the yield will be equal to the risk-free rate plus a premium for inflation, and then this additional risk premium, which is attributed to credit risk, liquidity risk, and the potential tax impact. So that is the spread. The spread on corporate bonds are impacted by several factors which are shown here. One is the credit cycle. Credit spreads narrow when the credit cycle improves. A spread is narrower at the top of a credit cycle. So in other words, when the credit cycle improves, the spread will come down. This is because when the credit cycle is good, money flows to these risky corporate bonds. When money flows into these bonds, the price goes up, which means that the yield comes down. A lower yield means that the spread relative to these risk-free bonds comes down. And obviously, the opposite is true. When the credit cycle deteriorates or worsens, then the spread will increase. Spreads are also impacted by broader economic conditions. Credit spreads widen in a weak economy and narrow in a strong economy. And here again, the reason is quite obvious. When the economy is strong, more money flows into risky corporate bonds. Since more money is flowing here, the price goes up, the yield comes down, which means that the spread will come down. And the opposite is also true. If the economy is performing poorly, then money flows into the safer government bonds, which means that price comes down, yield goes up, and the spread increases. The next point is related to funding availability in the financial sector. Unlike stocks that primarily trade on exchanges, bonds usually trade over the counter. Brokers and dealers are market makers in the debt market. Yield spreads are narrow when broker-dealers provide sufficient capital. But when there is a crisis, which is what happened in the post-2008 period, many broker-dealer firms either closed down or were acquired. The capital available for making markets reduced substantially, and this led to wider spreads. Then we have general market supply and demand. If the supply is relatively high compared to demand, then credit spreads will widen, and the opposite holds. If the demand is relatively high and the supply is relatively low, then the spreads will tighten. And the final point has to do with the financial performance of the issuer. Earnings releases, news, and other developments associated with the issuer will impact credit spreads. Good news will narrow spreads, while bad news will obviously widen spreads. Now I want you to work through this example in the curriculum. Let us now talk about the return impact of a change in spread. So let's say you own a bond portfolio worth $100 million, and let's say that the modified duration of this bond portfolio is 10. So what will happen if the spread widens by 25 basis points? So the change in yield spread is 25 basis points. Now to calculate the return impact without any convexity adjustment, we use the simple formula that we learned at level 1, which says that the return impact is equal to minus modified duration multiplied by the change in spread. So the modified duration is 10, so we put minus 10 multiplied by change in spread. This needs to be expressed as a decimal. So 25 basis points in decimal would be 0.0025. So based on this information, we can tell that the impact on the value of the bond is 0.025, which is equal to 2.5%. So this particular bond portfolio will come down in value by 2.5% if the yield spread widens or increases by 25 basis points. So this is a basic calculation without convexity adjustment. With convexity adjustment, our formula looks like this. So the first part is the same. So minus modified duration into change in spread. And to this, we need to add the convexity adjustment, which is plus half into C. This is the convexity of our bond portfolio, multiplied by the change in spread squared. So if our convexity is equal to 50, for example, then this number becomes, so this is as before, this is 0.025, and then plus half multiplied by C, which is 50, and then the change in spread squared. So this would be 0.0025 squared. Key point is that this must be in decimals. So this is the total impact when we take into account the convexity adjustment. Now exactly this calculation is done in example 9, so I want you to try this. Now this is a very basic refresher from level 1 in case you need it, otherwise you can just go to the next screen. But here is the idea. If you look at a bond portfolio, we have price over here and yield or interest rate on the x-axis. Typically for a non-callable bond or a portfolio of non-callable bonds, you will have a price yield like this. Let's say that we are at a given point. Now if the yield widens, the yield spread widens, then we move down. So the new value based purely on duration is given by this value over here, and then this small amount is the convexity adjustment. So you've seen this at level 1. Hopefully it's not an issue. The key is to just refresh your memory and be able to use these two formulas. Up till now, our discussion has focused on investment grade corporate bonds. here in section 7, which is the last major section in this reading, we take a look at high yield bonds, sovereign bonds, and municipal bonds, and specifically from a credit analysis perspective. Let's first look at high yield bonds. High yield bonds are bonds that are rated below a triple B, so below triple B minus. These are also called junk bonds or non-investment grade bonds. The curriculum gives several reasons for why a given bond might have junk bond status, and these include highly leveraged capital structure, so this clearly implies high risk, a weak operating history of the company, low or negative cash flows. If the company issuing the bond is in a very cyclic business, that creates risk, poor management, and so on. When doing a credit analysis for junk bonds, there needs to be a special focus on liquidity and cash flow. When we say greater over here, we mean greater compared to regular investment grade corporate bonds. So we need to look at how much cash is on the balance sheet, what is the working capital, how much operating cash flow we have. So if cash is coming from these sources, then that's a good sign. On the other hand, if company is raising cash through bank credit or through equity issuance or asset sales, then this would be a negative sign. So that's liquidity analysis. Again, a very high level set of comments here, but this is a important aspect of your credit analysis. Next, as credit analysts, we need to look at detailed financial projections. And this essentially highlights a point that we'll make later also, that the analysis of junk bonds has a lot in common with the analysis of equities. Debt structure is important. When we are evaluating the issuer of junk bonds, we need to understand the debt structure. So we need to understand how much debt is senior, subordinate, and then within senior and subordinate, secured debt versus unsecured debt. So we've talked about debt structure earlier. Here we need to understand the debt structure of the entity issuing corporate bonds, and then for the particular issue that we are evaluating, where in the debt structure it falls. When we perform an analysis, an important ratio to look at is the debt to EBITDA ratio, and this is often expressed like this. So the example given in the curriculum is a number such as 5.2. So 5.2 times levered would mean the total debt divided by EBITDA is 5.2. This particular ratio we should do for every level in our capital structure. So every kind of debt, senior secured, senior unsecured, etc., we need to come up with this ratio. When you look at example 10, you will see how this is done. And in example 10, you will also notice a distinction between gross leverage and net leverage. In gross leverage, we do not subtract cash from debt, whereas in net leverage, we take debt, subtract out the cash, and then divide by EBITDA. So this is a fairly straightforward example, but you still need to spend a little bit of time studying it. Understanding the corporate structure of the issuer is important. The curriculum gives the example of United Rentals Inc., which is a parent company or a holding company. This has multiple subsidiaries. Now, when we are evaluating a particular issue, we need to understand whether it is coming from the parent or whether it is coming from one of the operating subsidiaries. So we also need to understand the debt structure within each of these entities and the particular issue where it falls within the debt structure and which particular entity is issuing that bond. There are no hard and fast rules about whether a bond issued by a parent or a operating subsidiary is more creditworthy. But the sorts of things we need to look at is if an operating entity has issued a bond, then we need to look at the operating cash flow of that particular entity and look at the level of collateral that is backing the bond. If a parent has issued a bond, then we need to look at what sort of cash flow is coming from the subsidiaries which can support the payments of that bond. If there are restrictions on cash coming from subsidiaries, then that obviously is a negative. On the other hand, if a parent issues a bond, it might have access from a diversified set of operating entities, which would be a positive. So again, there are no hard and fast rules. The analysis of junk bonds from an issuer that has a very complicated structure requires a detailed analysis of that structure and the cash flow of each of the entities involved. Covenant analysis is important in general, but it is particularly important when we are evaluating junk bonds. A few covenants that come up more often in the context of junk bonds are as follows. One, change of control puts. This basically gives the bondholders the option to put the bond back or sell the bond back to the issuer, possibly at a premium, if the issuer is taken up by another company. This is to avoid the risk of the issuer being taken up by another company that is financially weak or that already has a lot of senior debt outstanding. Another possible restriction we might see here is a restriction on payments. So these would be restrictions on payments to equity holders, for example, the idea being that there should be enough money to first pay off bondholders before payments are made somewhere else. We can also have limitations on liens or limitations on additional debt. Again, this is for the benefit of existing debt holders. And finally, we need to look at the concept of restricted versus unrestricted subsidiaries. And this is actually related to corporate analysis in that this deals with whether cash can flow from subsidiaries to the parent company. Restricted subsidiaries can help pay off the debt of the parent. These tend to be the issuer's larger subsidiaries which have significant assets such as plants and other facilities and hence often have correspondingly large cash flows. The final point here is one that I touched upon earlier, that the analysis of junk bonds is a lot like the analysis of equity, and there is sufficient evidence that points to the fact that the risk and return profile of high yield bonds falls somewhere in between the risk return of stocks and regular corporate bonds. So if we look at risk versus return, if stocks are over here, bonds are over here, then high yield bonds will fall somewhere in the middle. And a lot of analysis that we do, such as detailed financial projections and so on, are quite similar to what we would do for equity-like investments. There also is a high correlation between the returns on stocks and the returns on high yield bonds. We now move on to sovereign debt. Sovereign debt is the debt issued by the federal government of a country. Historically, sovereign debt has been viewed as risk-free, but given the events of 2008 and the recent Eurozone crisis, we know that this is not necessarily the case. So clearly, sovereign debt needs to be analyzed carefully. Countries are best able to service sovereign debt if they run twin surpluses. So this simply means that they run a current account surplus and they also run a budget surplus where revenue is greater than the country's expenses. So if these two surpluses are in place, then a sovereign or a central government of a country is in good shape to service debt. When we are evaluating sovereign debt, there are two key issues to look at. One is the ability to pay, and the other is the willingness to pay. Credit rating agencies distinguish between local currency debt and foreign currency debt. Now, while the ability to pay is related, but clearly all else equal, the rating for local currency debt will be better than the rating for foreign currency debt. The curriculum doesn't spend much time on the issue of sovereign debt, but it does present a simplistic framework which is adapted from S&P's methodology. This is in bullet point format and you can read it from the curriculum, but if you are too lazy to do so, I will give you a quick summary on the next slide. So broadly speaking, this framework has one segment that deals with the political and economic profile of a country, and the other which deals with flexibility and performance profile of a country. On the political and economic profile side, we need to look at the effectiveness, stability, and predictability of the policy making institutions. So this can also be sometimes thought of as political risk. If the central bank and the finance ministries of a country are effective, they are pursuing stable financial policies, the policies are predictable, then obviously that is a positive in terms of credit rating. The other important point is perceived commitment to honor debts. So this goes with a country's willingness to service debt. Obviously, if the perceived commitment is high, then that's a positive. And finally, we look at the economic structure and growth prospects. So if the economic structure is strong, the GDP per capita growth rate is high, then the credit rating will be relatively good. The curriculum gives a few more points, but these are the fundamental ones. In terms of flexibility and performance profile, we should look at the external liquidity and international investment positions. So countries with very actively traded currencies that are used extensively around the world, such as the dollar, euro, yen, etc., would generally be in a better position than other countries whose currencies are not so widely traded. So if a country whose currency is not so widely traded runs into economic difficulty, or if global capital is not flowing into that country, then it is more likely to default on its sovereign debt. Fiscal performance, flexibility, and debt burden. So this is rather obvious. If the debt burden is high, then that limits the flexibility and that limits the ability to repay debt. So the credit risk is high. And monetary flexibility, this refers to the sort of monetary policy and monetary flexibility that a given country has. So take the case of Greece, for example. Monetary flexibility is extremely low because it cannot print euros, so the credit risk will be relatively high. I would now encourage you to spend a few minutes and look at the framework that is presented in the curriculum. It's only over a couple of pages, and as I mentioned, it's in a short, crisp bullet point format. And then also take a look at example 11, which does a quick sovereign debt analysis of Portugal. Non-sovereign government debt. This is debt issued by a state or a province or a local government. So any semi-government entity or government entity other than the federal government. Since the world's largest municipal debt market is in the US, generally when we say municipal debt, we are referring to US municipal bonds. These are divided in two categories: general obligation bonds and revenue bonds. General obligation bonds are unsecured and issued with the full faith and credit of the issuing government. So these are based on taxes. So bonds are issued and investors or bondholders are paid based on the entity's ability to raise taxes or to impose taxes. So when we do a credit analysis of general obligation bonds, the most important things to look at are the ability of this municipal entity to impose taxes or raise taxes. So we look at items such as employment. So if employment numbers are good, that means that it would be relatively easy to impose taxes or raise taxes. We need to look at things such as per capita income. Again, if this is high, that makes taxation easier. Per capita debt. If per capita debt is already high, then imposing taxes might be difficult, and so on. So these are the main elements of credit analysis. We should also look at whether the municipal entity is relying too heavily on just one or two types of tax revenue, because this can be risky. If an entity is relying exclusively on capital gains taxes or sales taxes, these might work in the short run, but if there are economic downturns, then there will be a major impact, and this implies a relatively high level of credit risk. Revenue bonds, as the term implies, are bonds that are serviced based on the revenue of a project. So if a state government issues bonds to build a toll highway, then that would be a revenue bond. The analysis, as you might imagine, is quite similar to the analysis of corporate bonds. One of the most important ratios that we look at here is the debt service coverage ratio, which is essentially the revenue divided by debt service payments. If this ratio is relatively high, that's a positive sign and implies that the entity will be able to repay the investors. As always, go over the summary, review the learning objectives. We have done all the examples in the curriculum. I want you to do the examples on your own also. Use the calculator as opposed to doing the long-winded calculation that the curriculum shows, but make sure you understand the concepts behind the examples. Do the practice problems from the curriculum, and if you have time, then do practice questions from other sources as well.